this combination of different strategies allowed us to provide downside protection for our investors. And like during these times, as the saying goes, the less money you lose, the more money you make. And it's important because I think a lot of people forget, if you lose 50%, you got to make 100% to get to zero.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. Here's your host, Sylvan.
Good afternoon, everybody, and thank you all for joining us today. Marc, a very well welcome to this live stream. Thank you so much for taking the time.
Hi, Sylvan. Nice to be here. Thanks for having me, and hope you're having a nice day so far.
Absolutely. You're the co-founder of AltAlpha Digital, a one-stop shop to a diversified and actively managed crypto and digital asset portfolio. That's exactly the topic that we want to talk about today, alternative investments. But before we do that, you actually have quite a career path to show, from asset management to working at Facebook and Google, joining the crypto space, and also with a few startups on your own in between. So I want to know from you, what really, sold you on the crypto part? Why are you active in the crypto space today? What got you hooked, basically?
So this was 2015, but then really 2016, where I kind of dove into it. And funny enough, this was thanks to my co-founder of the second startup that we had, who's an engineer, so a developer. And then back then he showed me Ethereum and what you could do. And as a lot of crypto stories start off, you kind of, you dabble around, you put in some bucks, see where things go. And then I really started to focus a bit more on especially blockchain in itself. So kind of taking a step back. That was also then the first book that I read, and that was then really in 2016. I suddenly realized, okay, this whole decentralized world, or this ecosystem that could be built thanks to this technology, is super interesting because, having worked in finance, I really saw, it's extremely centralized, and that has pros, but also cons. And I just thought this concept was extremely interesting. And, again, kind of being in the startup space, felt super interesting. Back then I was also in Stanford. So I had this whole, crypto valley vibe over there, kind of buzzing. And those were all pointers that told me, okay, Marc, you should maybe take a closer look at things here.
So it's really the potential that basically got you sold or hooked on the technology. If you looked at today's market, the markets are very volatile. Even stable coins that are not supposed to change that much are being wiped out. So currently in these days, are you really significantly concerned? Do you have sleepless nights these days?
No, so luckily I don't. But yeah, to your point, crypto is volatile. Now, for me, luckily, this is nothing new. I would be lying saying, I'm completely used to it. It's never great when you have these big drops. But I think, again, what people are seeing now is, cryptos, we talked about a lot of opportunities, but there's also a lot of risk involved. And I think some people saw this now very, very, very painfully. You were addressing stablecoins. I think for those people, some really got hurt badly. And I think the worst part for me is a lot of people, they go in, they think they're conservative, they're market neutral, as the saying goes, and they can make, 20% a year. That's like every asset manager's dream. But no, you have an inherent risk, and you really have to, buyer beware. And so this, I hope this is, again, it's very unfortunate for the people who got hurt here, but I hope it's, again, a wake-up call, to be cautious, to be aware. But now the market overall, look, this is not the first time. This is not going to be the last time. We're still chugging along. This was a massive implosion that happened. Billions of dollars just got wiped out. But again, the system's still standing. It's going on. People are going to learn from their mistakes. And again, we're still very early in building what seems to be, a new economy, a new societal, framework in the future. But again, in the future, so we still have a way to go.
Yeah, at the same time, you said it's a wake-up call. So I think that's a really important part, because if you have a high reward, like the 20%, you also have a higher risk. So don't forget about that. High risk equals high reward. It's also vice versa.
Yeah, look, there's no free lunch. And investing in cryptos directly, people know, okay, volatility there, it can swing massively to the up, but also the downside. But I think especially, again, stable coins, all of these quote unquote market neutral strategies. And I think that was because people were investing this and thinking, they're safe. And yeah, they now found out they're obviously not.
Now in these volatile times, what role do actually alternative investments play? Are they a good idea to have in your portfolio, especially for these volatile and turbulent times? Or do they actually even hurt your performance? What's your review, your take so far with what's going on?
First and foremost, it always depends. And this depends, at the end of the day of the manager. You can have good ones, you can have bad ones. But in general, if you look at kind of portfolio construction theory, it's really about finding uncorrelating assets. Because what you don't want to have is a portfolio, where everything goes up together, but also goes down together. You'd like to have, one portion goes up, the other goes down. And like that, you can always kind of balance out an effect. And that is something that, alternative investments have really been able to provide. And so what are alternative investments? Let's quickly take a step back. So traditional investments are classical, the stocks, bond, things you can easily buy on the exchanges. Alternative investments are in this bigger segment where you have real estate, the house you live in, or also art. Then you have commodities, which gold, silver, or wood, or on the energy side, gas, oil. Then you also have hedge funds, which these are in the crypto space where we focus on, but also in the traditional world, that's where everything started off. Hedge funds running strategies on equities, on commodities, so on and so forth, that have this active management. And then also most recently, digital assets, crypto, blockchain, whatever you want to call it, is now also, being more and more kind of showed and portrayed within this alternative investment bucket. And that's so kind of like the backdrop of the landscape. Now, what you've seen here, like commodities have an incredible run this year. Some commodity beverages, like for example, ProShares, they offer like leverage, so ×2 products, which just recently I saw the numbers for, and that means ×2. If a unit moves by 1, they move by 2 in both ways. But like oil was up year to date by 100%, gas was up, 300%. Again, we have the leverage in it, but we're also hearing about the news and media. We're having an energy crisis. We don't have enough oil. We don't have enough gas. Consumption is still high, so this puts pressure on the price. And at the same time, you then also have hedge funds who are able to play and work with volatility, making you money. But also here, just only having alternative investments doesn't mean you're fail-proof. Look at venture capital. Got smoked. Like the Refinitiv Venture Capital Index year to date is minus 47%. Some very famous venture capital or hedge funds in the space and also, lost around 50%. So again, like in the beginning, just being in alternative investments doesn't mean you're safe. They're different segments, and then are the different ways to approach it.
Yeah, I think that's a very good take. What you just said, it's like, doesn't mean that you're safe, but you can basically even out the losses to a certain degree.
And look, the good thing is, like, for example, with the Picasso, and then I'll jump on it, these assets are often illiquid, meaning if I have a Picasso at home, let's say it's worth $1 million just for the sake of numbers, stock market crashes tomorrow. It's not going to have like a ticker on this bill, in the back that suddenly goes, it's less, worth 50%. So, and like that's liquid there's a pro and a con. The negative side is if I need to sell like immediately, okay, a Picasso, I might be able to sell it quickly, but still there are a lot of things where you can't get to the money, or, you have a lockup period for years and you don't get out of the money. So again, these are pros and cons. And at times it's also just, if the investment is locked away or you don't get updated, every few days, it can also give you a peace of mind that you don't really know what's going on, but you don't see it crashing in your portfolio.
Yeah, that's a very good point, to keep your mind calm even in turbulent times. One thing, you shared some statistics with me when we talked about the preparation for this live session, and what really struck me was like that of the ultra wealthy, an average of 81% have alternative investments. Why is that the case? That sounds like a very, very high number.
Yes, so it's a high number, and this can have a case, different reasons. I mean, on the one hand, if you look like the ultra high wealthy, very often, what are these people? These are entrepreneurs, so they build companies. And when you build a company, then by definition, unless you have an IPO, it's an alternative investment. At the beginning, you do a startup, it's venture capital. And then through the later phases, you build a bigger company, it becomes private equity. Then up to the point, okay, you can have an IPO and suddenly you're liquid. Then it again becomes a traditional asset. But I think that is a reason. If you look just most like the investors I know, some are like to 90% illiquid. they have real estate, they have their companies, and like a lot of founders, they put all their money into their company. So that is like a reason for it. The other is if you look at like big also endowments that have played a big role. So endowments are, kind of like the treasury, the fund, the asset managers of these universities, Yale, Harvard, et cetera, that are sitting on a ton of money. And, some years back, the manager of Yale, who passed away, Swenson, led the charge for these university endowments to invest more in alternative investments, up to the point where I think it was, around 60% of their portfolio were in alternative investments. And, his returns gave him right. He was making good money, diversified, year on out. And so I think also there, just with the development, people realizing you have to kind of, the 60-40 model, which was very well known, 60% equity, 40% in bonds. We're now realizing, okay, it might not work as well as we thought, or it no longer works. In the past, that might have been. And so people have to get more creative. And that's where then alternative investments come into play.
There's, of course, also the very interesting questions, the ultra wealthy that you described. Did they get there because of the alternative investments, or did they only start doing the alternative investments once they were ultra wealthy?
It's a very good point and a fair point. And I think especially, let's take the entrepreneur route, you start building up a company, and how it often goes, you put in every cent you have into the one company until hopefully one day it starts to make money. And then, knowing some of these cases, well, then what do they? Okay, real estate. Start to buy, maybe buy your own house. Then you take investment objects, maybe apartments. And then at one point, well, what can you do further? Then quickly art comes around the corner. And it's also, if you have a Picasso, it's special, or the digital world, NFTs. I mean, that's a different topic. And but then also in between, you suddenly have hedge funds come to play. And I'll give you another example where during this whole macro backdrop, the group, the BFI Capital Group, out of which we operate, and we have multiple companies running, we also realized that fixed income was something with just the whole loose monetary situation we were finding ourselves in. We were no longer comfortable investing significant amounts of our personal and our clients' money into these segments. So we had to find an alternative, and we needed to find something that provided very boring, strong single digit, 5 to 8% a year. And then what we created was a fund of fund in the traditional world, where we were looking for these different strategies. We put it in a basket. And so, that's the goal, 5 to 8%, very boring, nothing special, but something that should provide this very solid bedrock of an investment portfolio. Whereas, our AltAlpha Digital is definitely much more aggressive, where it's really investing in future investments. And so that's how, at the end, that's how you want to kind of build your portfolio. Often, it's referenced as a pyramid. You just need a solid base, because if that base gets pulled out, the whole thing can quickly collapse.
Yeah, absolutely. So then, when you talk about the alternative investments, the access is usually quite a challenge, right? Because as normal investor, I usually don't have access to these deals or to these investment classes. So despite, of course, partnering with you and giving me access to these deals, how can I, as a normal investor, actually get access to the alternative investments?
So I think there are two layers. First off, the normal investor. In the legal terms, it's, there you have like retail investors, you have professional investors. And I think that's one important thing, that this will be different, per country, but there's always, like for example, Switzerland, if you have like assets for 2 million or $500,000, the respective financial knowledge, you can then qualify as a professional investor, which then allows you access to these tools. And again, each country has different rules, but even if you have that, it's still tough. And, it's tough. And I'm going to give you some examples. Like, for example, we have, crypto hedge funds, we invest in, minimum ticket is 1 million. So you have the case, you have your $500,000 together. You're not even going to get into that one. But even if you could, are you going to put everything into one strategy, into the hands of one manager? Poof. You really got to know what you're doing. You really got to be off your rocket. That is like one thing. Or if you look at private equity, I talked with, another manager, the minimum ticket is 30 million. So you see, it already starts off with these minimum tickets. Obviously, there are also lower ones, like for 100,000, but still, it's very tough with a lower capital base to have a good diversified portfolio. That is the one thing. The other thing then also is even the access of getting in, because some of these very hot deals, they're closed for new investors, because some strategies can only take a certain amount of capital before they start to become inefficient. And that's the other thing. And then the next thing is, you also have to find them. I mean, I spend very, very much of my time searching. And it's a painful process, especially in the crypto space, which is so new and things are all over the place. I mean, you are just going through data, meeting people, and you really have to start to dig yourself into this whole environment where, in our case, we're lucky to have someone who's very embedded in the scene, who bought his first Bitcoin in 2012. So that helps us a great deal. But these are all challenges that, quote unquote, as you put it, normal investors are facing. And it's hard, but like now the positive side, there's new product innovation that is coming. And like, for example, we are using that is, a lot of people know funds as a structure. Now in Switzerland, what has become very popular are AMCs, actively managed certificates. And they've become popular because also in our case, you can already start investing for, as low as 10,000 Swiss franc. And this right away, very much puts you at a different park if you have to decide, I have to put in 1 million or 10,000 Swiss francs. And so these solutions have been helping and fueling in a lot of different areas where now suddenly people can do venture capital for 10,000 or art, et cetera. And so this is something that in the recent years has really been helping these people. But again, buyer beware. If you have the wrong manager, things can go south.
Yeah, I mean, that's always the risk, I guess. You focus on crypto, right? So people often also ask themselves who are not that deep into that topic, what is the gap between the hype around crypto? Because, we read about all the people that got rich fast with crypto, etc., versus its real value, because there seems to be a gap, and I try to understand how big it actually is.
So I think real value, and it's going to be hard because it's going to be very subjective. And this is also going to massively depend on what you look at. So, I mean, the hype, let's start off with that. I think first off, to understand, a lot of people just talk about cryptocurrencies and think that, these are currencies that want to dethrone the dollar, or the Swiss franc, et cetera. Yes, there's some projects that try to, but the space is much larger. I talked about blockchain in the beginning, which is, the foundational technology. And then based on blockchain, yes, you have cryptocurrencies, but you also have tokenization of real world assets, kind of bringing them to digital sphere. You have utility tokens, then you have like NFTs a second. So there's a lot going on. So first take that step back. Now, that being said, there's a lot going on. 80, 90%, I don't have exact numbers, but a lot of it is going to be rubbish. It's going to be rubbish because a lot of scams going on, but this is not crypto specific. We also have in the quote unquote offline world. So you have the scams, you got to watch out. Maybe it has a larger magnitude because everything is on the internet, everything is online. It's much quicker, accessible, and you can go in for smaller amounts. But then again, also here, we are building a future, and a lot of things are still a big experiment that entails a lot of risk. Again, you can get a lot of return from it, but the risk stems from, the teams not being up to the task, the technology not working, teams being too early, teams being too late. I mean, it's like kind of in the startup world that you also know well, there are so many things that can go wrong. And this can be maliciously, or this can just be, it just didn't work out. People were doing all they could, but it just did not work out. And so I think that's very important to know that, people can get hurt by going, especially if you go in these small altcoins. And, I've heard a lot of people saying, hey, I bought token XYZ. Why? Well, for $100, I now have 1 million tokens. And if the token goes to $1, I'll have made 1 million. Very simple math. I've heard it quite often, people saying it. So again, here, don't bet the house on it. Start small, do your experience. And also with me personally, when I started, I've sent money to Nirvana. I've done ICOs, they went well, and suddenly poof, they delisted, it was nothing worth. I've kind of, had exchanges that blocked my money, and then so have all these things happen in the years back. So I learned a lot from those mistakes. And but still overall, we are very optimistic. But no, look, it's going to be a bumpy ride, ups and downs. And that's also why we are setting on active management, because it's still so immature of the segment that you really have to be on top of things. It's tough to do that.
That's probably where I would say active management is one of the few cases where it actually makes a lot of sense, because they do need to stay on top of the game, right? And what you just described sounds a bit like Wild West. There are, mistakes that happen. You do lose money, and that's probably part of the learning curve. Now I'm really interested in learning more about what cryptocurrencies or crypto assets do you actually focus on. So where do you see the potential and what is actually working well for you? Of course, no investment advice, but just sharing your experience.
It's just in our case, we're looking at different segments. So because on one hand, if you look at the crypto economy, you have decentralized finance, you have like the gaming space, you have the payments, you have so many different topics that really you should think of it as an economy on the one hand. But on the other hand, then there are also a bunch of different strategies that range from kind of the long only, being you invest in tokens where you take this fundamental analysis paired with a bunch of other things, but basically you build a conviction that token A is going to grow into the future. You're going to buy it now and you're going to hold it. That's like one part of it. And then you also have people that at the end of the day, they might just be trading the volatility because crypto is extremely volatile. And for certain strategies that works very well, these are then maybe quantitative strategies where then a machine does the buying and selling with derivatives. So actually paper contracts. And also there, very interesting. And then you also have strategies that are market neutral or not so market neutral. DeFi yield farming. You have on the one hand where you're staking coins, you're providing liquidity, and basically DeFi yield farming. It's like an interesting space because if you look, having worked in the finance sector, it's going to get disrupted. Like so many sectors before. And look, there's going to be a day where people are, the generations past us are going to say, crypto, that is so old school. There's this new thing. So I have no false anticipation that at one day the people say, Mark or Daddy or whatever, that was like, so 2020 what you were doing. But that being said, with DeFi, it's on the one hand, it's really kind of taking the role of the bank. And you have codes, smart contracts, mainly that, provide these services that provide the automation of matching orders, sending money from A to B based on different conditions. And then now this is the interesting part where versus the banks being the ones, that provide liquidity or institutional players, you now suddenly have all of us, this peer-to-peer approach where you have Bitcoin, I have Ether, we're sitting on it. Hey, we want to make some money. We can put it in a pool and generate fees off of it. Obviously, that can also go south because, again, you carry the rewards, you carry the risks. And so we think that is a very interesting segment that also we have like one fund we invest in that only focus on tokens. So not DeFi as an activity, but really just the tokens, kind of like buying the equity of the banks. Because DeFi yield farming, we just see a lot of risks, which has now been shown, that we just didn't feel comfortable as of now investing in it. That is one segment. I think gaming is super interesting. I also was a hardcore gamer back in the days. Gaming is a big industry, in the quote unquote normal offline world, and it's also going to be a big one in crypto. And I think like an incredible, interesting part for me is I invested a lot of my time in the days in gaming, and I'm sitting on all these assets that a lot of blood, sweat, and tears in building them up in, characters, inventory, whatever it may be. And I paid for all this stuff, but I don't own it. I can't do anything with it. I cannot move it around. I cannot, some things you can sell now on, certain markets, but at the end of the day, like Steam or these operators or these companies, they own the assets. I don't own them. Even though I paid, also in Steam, I paid for the game. I can't sell it. Now with crypto, you can suddenly do that. I can have, a sword or whatever it is, an NFT, and suddenly I can sell it. I can move it around. So I think like, investing in games, on the one hand is interesting, or investing in infrastructure, like these marketplaces around are also something that is super interesting. And also, like, for example, stablecoins, obviously it is now not a good time on the marketing side, but financial inclusion and like these very primitive abilities for you and me, look, this is not interesting. We're sitting in Switzerland. Our system works very well. We have Twint, we have all these things. I don't need to use stable coins or Bitcoin, and I never would sell Bitcoin, to buy like a Coke or whatever, or some food. But in a lot of countries in the world, this is extremely important, where you have, Latin America and a lot of developing nations, 50, 60, 70% of the people are not in the banking system. And this is 2022. So they have, they're not going to get in the banking system, my personal opinion, in the near future.
That's crazy.
Yeah, and so this is a big part. I've also talked with these recently, also someone again from Latin America. They have completely different problems that we don't understand. And you could say thank God that we're in such a privileged position. But so there's all that space where it's not about capital gains, about the simple things. Where suddenly with a smartphone for $50, you can have your own bank account. Suddenly you can save money, or remittance payments, sending money abroad, where people emigrate and then they're using these traditional finance institutions, and they're going to take 20-30% of your cut. That's, if you like, for those people, $100 or $70 is a big difference. And so I think, again, it's not that sexy, but that is, again, another aspect that is very interesting. But yeah, recently, again, it shows you really have to be cautious. So I hope, that, again, I stated before, the sector will learn, will develop.
But I think it shows really the potential. There are so many different ways of generating return in your portfolio with the new assets, the crypto, but also the digital assets that you just mentioned.
If I look at the global backdrop, I mean, like Bitcoin, Ethereum are about down 40%. And if I look, like, for example, because I just said, like, S&P 500 is about down 18%. The SPI covering Switzerland is about -12. The TLT, which is like the 20-year plus basket of government bonds from the US, fixed income, highly secure, et cetera, it's down over 20%. And then, going into like the tech, because I haven't worked Facebook, Google, I mean, NASDAQ had its worst month in April since 2008, losing over 13% in that, and then also you have like the companies like Shopify, really love the product, but I mean, they're down -70%. Meta, Facebook is -40%. Google, Microsoft are like -25%. So this is a very rough backdrop. Like a lot of people are getting hurt out here. Venture capital index also down -45%. So it's a very challenging environment. And therefore, that being said, we are also a more aggressive fund. So we don't sit on the sidelines. But what we do is, we're a fund to fund. And maybe to quickly explain that for people who might not understand, it's not that me or, us as a group and team run around, buy Bitcoin, sell Ethereum, etc. Because we realize the space it's way too broad. This is, no chance. We cannot cover it. Again, we have like people who have been in the game for a long time, but it's too much to cover. And so instead of us trying to do everything ourselves, we said, look, let's go out, let's find the best talents out there and put them in one portfolio. And so I compare it to sports where you have like offense, midfield, defense. And so we have some aggressive players, and obviously when things go down, they're going to be hurt more. But again, when things go up, they're going to be the ones making the money. Then we're going to have midfield players who, at times they can be more aggressive, at times they're going to be more defensive. They can kind of, depending on how they read the landscape, they'll adjust. And then we're going to have defensive players who really, hold the line. And basically this combination of different strategies allowed us to provide downside protection for our investors. And like during these times, as the saying goes, the less money you lose, the more money you make. And it's important because I think a lot of people forget, if you lose 50%, you got to make 100% to get to zero. That's like, it's very simple math, but that's why the less you lose, the less you have to then go up to then again be positive.
I think, yeah, that's a very good saying. I'm not sure who said that. I think it was like Warren Buffett.
Like the first rules, don't lose money.
Exactly. I also wonder, so you now seem to have a better downside protection, right? So you're less down than the general markets with the alternative investments. Does that necessarily also mean that you have less ups, like less increase of the value of the portfolio compared to the NASDAQ, for example?
If things go well, no, like especially the NASDAQ, it's in the cards to outperform that. And again, I guess here then it's a bit, unfair because crypto again has a lot of volatility, but also much more to the upside. And, we've invested in funds like in the last year, they've done 200%, 300%, 400%. So it's quite, it's quite a sign. And that's then also the part where the active management comes in, because that's the expectation that at the end of the day, these managers that, they'll have focus points, they might just focus on DeFi, or they might just focus on kind of mid-tier tokens. And that's where you generate alpha. And this is how then theory and practice should go. Their ability to then really select and find these players early and invest with them to generate this outperformance. And that's why, also some of our aggressive players, they're invested in the market, they're staying put in there because these markets can rip quickly both ways. And if crypto suddenly, again, does one of their victory laps to the up, and that can, they can charge like massively up, strong double digits a day. Well, you don't want to be the one who are like, the managers are scrambling to kind of get back in the game and are losing these very important days. And that's why we have this combination. And that's also why, again, looking at the past, but this is as obviously never a guarantee for the future. Also there, we should be able to have, a strong delivery. But hey, time will show. We think, this could still be a bit of a rough market, but this is just in general. This is not just crypto. I mean, I listed these, these numbers and the indexes. The whole world is getting smoked here. No, so this is a stress test.
That's right. Absolutely. You mentioned the active management multiple times. Of course, that doesn't come free of charge. So how does your fee structure look like?
Yeah, nothing in life is for free. The same thing. I mean, at the end of the day, also someone should hopefully pay me and us for our work. Now, our fee structure, we have different fee structures, and this depends on how much you invest. As of now, our strategy is running in an AMC, which, 10,000 is the minimum. So it's a lower minimum in there. We have a 1.5% management fee, and then we have a 15% performance fee, basically meaning, if we go from 100 to 200, that 100 delta that we were able to grow, we're going to get 15 of that. And that is also so-called incentive alignment, because you don't want me to just get, and us to just get paid for sitting around and also get paid when things go down. You want us to be interested that, things work out. And that goes here, incentive alignment. Our personal money is invested, my money is invested, my family's money is invested, my friends are invested. The same goes for a group. Employees are invested. We have their spouses, their friends who are invested. So this is really something that kind of started for us. And I'm going to more phrase it as kind of like a co-investment at the end of the day. And now getting back, we're also now close to launching is a fund. In addition, the fund will have a higher minimum of 100,000, and there we're going to have something special, being an early investor share class, meaning that those people who get in at the beginning will be securing rights to strongly reduced fees of 0.5% management and 5% performance fee. And also, if let's say a year or two down the road, they decide they want to put in more money, they'll have the same terms. So that is something that a lot of people are interested in. And, once that share class is kind of then gone, we're still going to have 1% management, 10% performance. And then we're going to have for like 500,000, 0.8 and 8% on the performance side.
What I also want to do is, for many people, that might be interested in the topic of personal finance, they think like, well, should I just invest in a stock ETF, cheap, diversified, less effort? Or should I also assign a portion or even most of my assets in the alternative investments that we just talked about? So I basically want to compare the two side by side on like three aspects. Let's start with the performance. You briefly mentioned before you are less down than the Standard & Poor's or NASDAQ. So performance-wise, you basically outperform the traditional stock ETF.
Yeah, but I think it's also it's not a complete. It's it is a different segment, and I think we have that in there just also because in this case it was important. The whole world has changed drastically. Now, that being said, also in the beginning, you want to have a diversified portfolio, and obviously, look, crypto for a lot of people, it's not going to be for them very clearly, and if then they're going to put a small allocation. So this a lot of people, you have like this 1% rule that's going around for those who are like very on the fence, because of the thinking is if you put in 1% of your portfolio and everything goes to zero, like worst case, it's not going to kill you. And I think that's a very important segment and statement there. Now, obviously, through time, these like allocations have gotten more aggressive. I hear like more like 1 to 5% people talking about that, or then even up to 10%. And obviously, you have the crypto diehard fans, and also myself. It's I'm much more in the roller coaster ride here because I'm definitely more into crypto. But that being said, position sizing, if you can't handle the risk, do it like that. Reduce the position, the exposure you have to something. So be prudent. And again, I think, all not being investment advice, but this will very much, again, depend on where you're going to invest in, because look, there's some things that just you can't get in without, you can't just buy an ETF. It's just not available. It's maybe going to take it, and maybe it's never going to be available. Who knows? So I think that then really depends on also like where do you want to go in? Also, what for type are you? Are you the day trader who thinks, you can outsmart the market? You go in and out, left and right. Are you the person who says, look, I'm just going to put money in and forget about it? But, that's like what a lot of people, most of, 90% or whatever it may be of the people are passive if they want it or not. But even there, everyone talks big game of buy and hold, put in, not look at it. And what happens? Markets, people look at it, people freak out, people start to sell. I mean, they're, and also here, like, we talk about alternative investments. Ray Dalio, I once listened to a podcast, and he's the founder of Bridgewater, like maybe one of the best hedge fund managers in the world. So, absolute name. And he brought this example of a fund. I can't remember the name, but the fund in of itself, excellent performance. But what was interesting? On average, people lost money. Why? Well, fund goes up, people invest. They're FOMO. Oh my God, there's so much money to be made. I'm really missing the train. They invest. The fund goes down. Things always come down. Oh, this is broken. It's not working again. The market crashed. I'm selling. So like this investment, it's very simple. You buy low, you sell high. Very simple. But what happens? You buy high, you sell low. And look, I've heard so many people in crypto, same thing. They were watching, they were saying this is rubbish. Bitcoin goes against 70,000, money starts pouring in. And now a lot of the same people, you ask them, so how are you positioned? Oh, I sold everything. This is, it's way too risky. It's broken. I knew this was a scam or whatever it is. So we as people, the human brain, the emotional psychology, I think we are quite a big, we're quite a stepping stone and a hindrance for a lot of people to make this work. That's why there's so few people who can do this professionally, because it's very hard. And especially now, last 2 years were great for the crypto space. A lot of managers were able to pat themselves on the back, and a lot of managers are bleeding now. And a lot of, the chick is coming home to roost. And I think this, again, is a good moment for people to see, okay, who can hold their ground.
Let's also look at the effort. I think there, with your structure and the ETF, the effort is pretty much the same, very low. You send money and then it's taken care of. So you don't really have to do a lot on your side with due diligence and investment decisions. That's either with your setup or the ETF taken care of for you.
With AMCs in general, and this is like a feature of the AMC that I personally very like. Yes, it's because it's in that sense it's a bankable product, so you can call your bank, and you're not even once timed it. I called the bank, waiting line. They pick up like, hey, do the security questions. Please buy, X amount of this product, and then you get like an ISIN, so CH, and then you have a number. And so that's the great thing, where I think, with these AMCs, it's very easy to do so. But now the difference is AMCs, because it's a professional investor's product, you have to call the bank. Whereas like ETFs, etc., they're open for the broader public. You can buy in e-banking. So that is a different. But like with funds, there's a bit more of an effort. You have to fill out documentations, etc., because it's a bit of a different solution.
Okay, but almost a tight game. Almost.
Yeah.
And last point that I wanted to talk about is the cost. I think we heard about your management and performance fees. So there, obviously, the costs are probably higher than if you have a traditional stock ETF at the lowest available cost of like 0.something%.
Yeah, no, that's absolutely so. I mean, if you look at like these big ETF providers, like Vanguard is very well known, iShares. I mean, as you say, for a few basis points, or like 0.06 or whatever, you can get something. But I guess there, what you always have to put into a relationship, you don't do investments based on cost. You don't invest in a startup just because it's the cheapest. Like you don't hire a person just because they're the cheapest. You want to have a healthy relationship of cost, benefit, and potential. And so look, if I look at our fee structure, I mean, it's comparable to the traditional world, but like the traditional equity world, I mean, it's going to be very hard to make like 3-digit returns if you look at those profiles. So that's also something where I think, investors have to look. Crypto, again, much more risk, but that's also where the return profile comes from. And honestly, if we have a manager that is just, delivering hundreds or, times they can even deliver thousands of percent. Well, man, I'm going to pay this guy, 5% management, 50% performance. It doesn't matter. If they're able to deliver that amount of return, then you're going to pay the people the same. If you're going to hire, a really strong individual that can just build companies, that can, sail, and that can, do incredible engineering, IT development, whatever it is, you're going to pay that person a lot more money. And so I think that's something that at times, I think it's also important for investors to realize, like, what are you going for? What's the return profile? What are the risks? How complex is it? And that's how, at the end of the day, these salaries then, so to say, are also, in my personal opinion, to be adjusted and considered.
Yeah, that makes sense. If you make a lot of money, it's also fair to pay higher fees in the end, I guess.
If you as an investor walk out with more money, I mean, yeah,
Sure.
there's no point in being able to say, hey, I just paid 0.06, but you're losing constantly money. I mean, yeah, great.
Absolutely. So to sort of wrap up today's episode, I have two last parts for you. The first one is like about the trends, and the future of the alternative investment in the crypto space. So what trends, what future do you see emerging over the next 6 to 12 months in your space?
Just quickly, I mean, alternative investments in general, it's been a growing segment. The numbers show it. And again, this is the umbrella of everything. And so I think that will continue forward. Now, specifically, I'm now really focusing currently on digital assets. I think it's it's always a bit of a hard question, but I think on the one hand, kind of like the segments that we mentioned in the beginning, DeFi is still something where I think, continuous growth, continuous development. Now, personally, gaming, there's also been a M&A activity, like with Microsoft, Activision, and the quote unquote traditional world. And so I think there in the crypto blockchain space, more is going to come because, yeah, a lot of things make sense. And there may be something that we just briefly brushed on. I think NFTs are interesting, but I think it's also interesting to note that, a lot of people have this notion when you say NFT, they just automatically think about pixel art, Bored Apes, CryptoPunks. And obviously that's, a application that is very well known because these things have, skyrocketed in price. And maybe also here, we don't do any NFT investments because that's currently more art than science, so to speak, but we do infrastructure investments through our funds. And now going back to NFTs. So yes, you have this art aspect, but what I think it's very interesting, it's this enablement of the creator economy. And, having worked again for like Facebook and Google, strong platforms, but, YouTube provides their creators with some revenue share, other services not at all. And so they're not getting any money of the content that these people are providing that are making these platforms sort of valuable. And like the same goes for artists. I mean, I talked with a painter, and like if these artists sell, like for example, a painting, the initial time, let's say they get $100, whatever it is, that's their liquidity event. That's when they make money. But if this painting suddenly goes to $1 million, they don't see a dime of it. They don't get any royalties. And now that is something where, in that sense, I think is very interesting for this whole economy. Suddenly you can make money every time this NFT is sold. Like a certain percentage comes back to the creator, and that's something you want to do. You want to support these creators. You want to support these individuals that otherwise is very, very hard to do. Like also Spotify. And look, I'm not dunking on all these companies. I work for them. I think they have great products. I use them every day. But still, if you have this niche band, I can listen to them all I want. Like the money that trickles down, it's not really going to get to them. It's going to be absorbed by these bigger players. And then, kind of moving away from the artist, if you look at the whole soccer, for example, or sports, scalping. So the black market of selling tickets you buy for $50 and suddenly it goes up to 1,000. It's often illegal because these sports teams are not seeing any of the money. And here it's the same concept. If they have a mechanism where they start to get, these returns back, this really changes the economics. And there's so many ways to use this technology. And I think that is something that's interesting. I think it's obviously there's a lot of hype and obviously there's a lot of money grabbing. I mean, we covered it before, a lot of bad actors. We don't have to go into that. But again, I think it's going to be a very interesting part to play moving forward. And I think a lot of people are just not yet fully understanding how this could really be used and what this could mean for a lot of individuals, in this kind of gig economy, if you want.
So certainly we're not only living in a challenging, but also a very exciting time at the moment.
Yes.
So, Mark, to wrap up today's episode, I also want to ask you some rapid fire questions. So, I either give you different options to choose from or a single question, and you have to answer in
Okay,
one sentence. You ready?
go.
What was your worst investment so far?
I invested many years ago in rare earth, kind of like what you use to do mobile phones, batteries, etc. Went well, then it went to zero. But the same goes for cryptos. I had some that went well, went to zero. And so, yeah, those are two bad investments.
Part of the journey. And on the other hand, what was your best one so far?
Okay, philosophically speaking, launching my own company, taking some money in the hand and launching something with friends, that was incredible. And on the investment side, it was also crypto.
Not surprising. If you had to choose Bitcoin or Ethereum?
Hard. I go with Bitcoin.
Why Bitcoin?
It's a hard decision, but I think Bitcoin, this unique setting that it has, being the first, and also I had a time where I was in the precious metals trade, so physical gold, silver, platinum. I also wrote one of my theses about gold. My master's thesis I wrote about blockchain. So this sound money concept is something that was always dear to my heart, and and a lot of people call Bitcoin the digital gold, exactly because of its properties, that it's limited, it's deflationary, and also it's something, if you look at this world, the reason why, we're in this mess is the loose monetary policy, where, modern money theory, where basically you can kind of print yourself out of debt and everything's going to work out. Would have been great. Would have loved it if it works privately for me, if I could just take more and more on debt and everything's going to be fine. Well, it seems like it's not really working. And it seems like there are consequences. So that point, and again, kind of going back for this primitive of this, the largest monetary network, but there's so many things I think are interesting about the whole concept, but also, again, topic of abilities of financial inclusion. But, I know I'm completely going over the one sentence answer.
That's all right. I think it's a good additional context. Capital gains or cash flow, if you had to choose one of them?
Well, taxes also play a matter, so I think I would go for capital gains.
Yeah, good choice in Switzerland. Stock, ETF, gold, or crypto? You have only one choice.
Well, it is. I'm going to put, how's the saying? The money where my mouth is, the food where my mouth is, it's crypto.
Thank you so much for joining us today. That was a lot of fun. All the best, lots of success with, the upcoming fund and everything else that you're building. And I'm sure we're going to talk again soon in the future.
Thanks so much, Silva. And it was my pleasure and had a lot of fun.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.